We're going to start in 5 minutes. Again, starting a little early because we're not sure the equipment is 100%, but it looks like it is, so the lecture itself starts in 5 minutes. Sound check. It's a little loud. Two minutes.
Been updated to reflect how we changed the lecture order, like in terms of readings?
Can't hear you.
In the course outline and timeline, has it been reflected so we know which readings we should have done?
In the course outline, we swapped basically the first two lecture sets because of the fact that the Bureau of Economic Standards is releasing the GDP data on Thursday. So we're doing business cycles first and NIPA second, as opposed to NIPA first and business cycle second. Then after that, everything will be exactly as the course outline promises. And it's 2:45, and here we go. And now we're down to the hardcore. Now that we know that this is streaming reliably, the true cult is here. So let's press on with what we're doing. And as I was just commenting in that exchange right there, again, we are inverting the first two lecture sets because we have been promised by the Bureau of Labor Statistics, not the Bureau of Economic Standards, that the GDP data for all of 2019 will be released at 5:30 in the morning on Thursday. And although I have an 8 o'clock class, I'll have to first teach that class, but then I'll pull down the data. And we'll be able to use current economic data to discuss the national income accounts, gross domestic product, consumer durable spending, and all that sort of stuff. So we are now continuing on this discussion of business cycles in the second half of this. And this is material actually you'll hear more than once in this class. This is our first discussion of the monetary issues like inflation, deflation, and interest rates. And they're so important that I actually returned to this subject 3 different times. Here you're having your first exposure to it because of the relationship of this in the business cycle. And then we'll come back to it when we start using our models that have a financial component. And then we'll return a third time when we start talking about Federal Reserve policy toward the end of the course. So it's always interesting to students to hear about these things and talk about these things a little bit. And so let's just move right into this. We will be, as of Thursday, a little bit behind because of the way I've reorganized things. We'll be about a half lecture behind, so the pace will speed up for a day or two, and then we'll be pretty much consistent with the calendar. All right, let's move ahead. So the biggest question, or the most important question perhaps that one wants to answer is, why is this discussion of price behavior, whether inflation or deflation, such a big issue in macroeconomics? It's central to many, many discussions. And if you subscribe to a financial newspaper like the Wall Street Journal or the Financial Times, discussions of inflation and deflation are omnipresent. And it's because of the outsized impact that that inflation and deflation has upon the economy. And so in this case, we're going to talk about it a little bit in the context of the business cycle. Now, why is it a problem? First thing you need to understand about inflation especially, but both inflation and deflation, it's not a problem for everyone. Usually, inflation will have the impact of reallocating income and wealth. And as it does that, it's obviously not a problem for the people that it reallocates income and wealth to, which sometimes makes inflation politically expedient or desirable to a particular class of voter or to someone who has undue influence upon a government. Specifically, it reallocates income and wealth unfairly, that is, unrelated to contributions to productivity or any other reasonable standard, generally from lender to borrower, those who lend money to those who borrow money, especially if the terms of the loans that were made were not in anticipation of inflation. And I'll come back and talk about that more because that's such an important topic. It reallocates income and wealth from salaried people because salaries tend to lag the inflation rate. And so there's a real reduction in salaries adjusted for inflation because of the truth of that. It tends to reallocate income and wealth from the elderly because of the way they hold their assets and because of their reliance upon established pension plans or a certain fixed feed from their retirement accounts, unless they are prepared for the inflation in their investment strategy. And more than anything else, it reallocates wealth and income to speculators. It's where speculators really gain if they anticipate the inflation and play the inflation. It's also a general problem for businesses because the presence of inflation, as we'll see through multiple examples beginning today but not ending today, injects tremendous uncertainty into the economic environment, and as a consequence of that uncertainty, slows down business spending generally. And so the mere threat of inflation can sometimes have a dampening effect upon gross domestic product. Now, with regard to the very first point made, that it reallocates income and wealth from lender to borrower, the perfect example of that is in real estate. And if you've already taken Econ 104 from me, I stress the importance of investing in real estate at the very end of the class because of this very phenomenon. If you buy a home right now, for example, no matter where you buy it, if you finance that home at interest rates of, say, 3 3/4%, which is more or less the going market rate for a 30-year fixed-rate mortgage. and then in 5 years we have a double-digit inflation that lasts for 2 or 3 years, you'll look like Warren Buffett in terms of your investment wisdom. Because, of course, your house will rise in value with the general inflation, but the monthly payment you make on that house is fixed by the loan terms on a fixed-rate mortgage. And not only is it fixed during the duration of the inflation, it's literally fixed for the next 30 years if you don't sell your house. And so, as a consequence of that, you have a substantial increase in your own wealth simply by virtue of the fact that you borrowed money to buy that house. So any business that has intermediate to long-term lending, and most businesses do these days because they sell intermediate to long-term bonds, benefit during an inflation because those bonds in real value, of course, decline in value, or the cash they earn from their business operations rises with the inflation. So bond service, which is in nominal terms, according to fixed rates that were set maybe 10 years ago, are a constant. So businesses like Apple and Microsoft and companies that have plenty of cash but also have a lot of debt for this very reason have substantial increases in their wealth overall because of this phenomenon. I should add as a footnote today that Apple had its earnings report at 2 o'clock, and it seemed to have been rather tepid. Apple stock did not fall in reaction to the earnings report, but it didn't rise either. It stayed about where it was, which is very unusual for Apple stock. It usually responds strongly one way or the other. And so this appears to be kind of an earnings season where it's going to be so-so, very possibly. Microsoft reports tomorrow, and we'll see how they do. But Apple doesn't seem to have impressed very many people. So income and wealth moves from one party to the next, and sometimes in substantial amounts because of inflationary episodes. And so the upshot of the real estate example is I tell students to make sure that if you have the opportunity and you live in a place where houses can be afforded, which excludes for most of you Silicon Valley, I guess, then buy a house. And buy a house when you first get married, before you get married, and of course raise your family, and always finance it with a fixed rate mortgage, because that will be one of the most substantial investments that you'll ever make if there's any inflationary episode in the next 10 to 20 years, and you'll be glad that you did. And you will effectively escape entirely the effects of the inflation, and the inflation will have effectively benefited you. So even though I wouldn't wish inflation upon an economy as a whole because it's bad for an economy, personally it would never hurt me because we have real estate holdings and my wealth would rise disproportionately if we had a bout of inflation that were to happen, say, in the next 5 to 10 years. You should consider putting yourself in that position as well, because, again, you will benefit actually from an inflation that probably in your lifetime is almost certain to happen. Not right away, but at some point or another, you're going to see inflation in your lifetime. To continue, it seriously threatens the financial markets because the stock market in particular tends to move inverse to inflation. That may seem contrary to common sense, because you say, well, isn't the price of a stock like Apple or Microsoft or Procter & Gamble or Ford a price? And don't prices rise during an inflation? Well, consumer good and commodity and service prices rise during an inflation, but that doesn't mean that all prices rise during an inflation. Because of the attractiveness of the high yields on bonds, middle to long-term bonds, then usually stocks have a tough time competing with very high bond yields during an inflationary period. So a review of data, as again we do in Econ 104, shows you that stocks tend to stay relatively flat during inflationary periods, which means that the purchasing power of the stock, of course, is going down because the inflation that the purchasing power is going to try to compensate for is going up. So the stock market tends not to like inflation. And then, of course, it invites a policy response from the Federal Reserve System, because the first thing you want to do when you see an inflation is try to stop it. And that policy response is often very draconian, very severe, hard upon the economy. One of the first reactions that you'll see from the Federal Reserve System during an inflationary period, even the beginning of one, or even when inflation is threatening but not yet in place, is a rise in interest rates, because that's how they try to slow the economy down. And that can have considerable impact upon the economy, can damage the economy. And then finally, as we're going to see here in just a minute, as goes inflation, so go interest rates, and rising interest rates are generally harmful for the economy. Interest rates in market terms, in nominal terms, that is, as the market actually prices them, will rise with inflation because real interest rates, which is interest rates with inflation subtracted, or interest rates adjusted for inflation, stay positive. Nobody's going to lend money to you at a negative real interest rate. They'll lend money to you only at an interest rate that is higher than the underlying or expected inflation rate. So if the underlying or expected inflation rate is 10%, you're not going to be able to get a loan for anything less than 12 or 13%. If the inflation rate goes to 16%, then the cost of getting a loan is going to go to 18 to 20%, and so forth. And so, as we'll see here in looking at historical data in just a minute, when prices rise, interest rates rise, and of course that can have a deadening effect upon the economy. We'll look at some examples, even in this lecture, that date back to the early 1980s when we had a severe inflation. That mark there at the top is a 2 million mark note from the hyperinflation in Germany, and this note was issued in 1923. And that note wasn't even worth so much as 1 penny of purchasing power in today's dollars. That's the example of the effects of an extreme inflation, and we'll talk about that when we formally get to the subject of inflation in this class. Inflations can turn into very serious inflations, and when that happens, you have a smoking black hole economy, an economy that reduces to barter and just otherwise can't function. So inflation is often perceived as a very serious problem. Equally serious in the modern era is deflation. Now, I would have thought in the 1980s and 1990s when I first started teaching here that nobody would ever have to talk about deflation in the modern era, because it seemed like the only real modern problem with price effects would be inflationary problems, because we were seeing some inflationary problems in the 1970s and 80s. Deflation seemed to be a thing of the past, as associated with, for example, the Great Depression, when prices fell by 25% or so over a 3-year period. But about 10 years ago, we began to see modest price deflation in some of the world's most advanced economies, and even saw some short episodes of it here in the United States. There was chronic episodes of deflation in Japan, mild deflation in Germany, and at least statistically, some very slight deflation for a short period of time here in the United States. And by that I mean that the price indexes that we use to measure deflation or inflation turned negative. The rate of growth turned negative. So there is a modern day threat of deflation that we explore later in this class. It is a cyclical phenomenon, as we're going to see, and so that's why we're talking about it some here. Deflation is actually a more serious problem than inflation, as serious as inflation happens to be, because of the threat of deflation upon financial institutions and lenders in general. One of the side effects of the Great Depression, when we began to experience the deflation of the 1920s that carried on into the 1930s, was the effect upon banking. It basically destroyed the banking system in the United States, such that Franklin Roosevelt, on his very first act of office, carried out literally 15 minutes before he was actually president of the United States, declared the banking holiday in 1932. I forget what the date was, it's March something in 1932. And it closed the doors or forced the closure of every bank in the United States for a period of 10 days. And then after the end of those 10 days, when the banks reopened, 1/3 of all that had existed prior to the banking holiday were never to be seen again. And another third was absorbed by the strongest third. And so there were only 1/3 as many banks 10 days later as there were before the closure. And almost the entire problem can be attributed to the impact of deflation upon those banks. Basically, if you look at it, it's fairly simple to figure out. If you owe a bank a loan, and that loan is in nominal dollars, in other words, say it's a farming loan. We were an agricultural economy back then, and so cycles in farming, of course, and agriculture matter much more than they do now. If you had a farm loan for $100, which would have been a sizable amount in, say, 1926, and if the price of milk was declining because you owned a dairy, then obviously the receipts from selling milk ultimately were insufficient to service the monthly payment on the loan. So, of course, you went bankrupt as a dairy, but the bank also went bankrupt because they never received payment for the loan. And so generally, because loans are denominated in fixed dollars, they're not adjusted for inflation or deflation, if the borrower has the incapacity to pay off loans because the prices of what they sell are declining, then the entire structure, including the banks themselves, are threatened. And as I say, this was so severe in the early 1930s that it forced the closure of all U.S. banks. Now, there's nothing been equivalent to that. Even the mortgage meltdown wasn't as serious as that in the modern era. And in the words of the sort of the jargon of economics, nominal amortized payment obligations, which is just another way of saying your fixed monthly payment that you have to make on any kind of loan, are harder to meet, which forces default. And then at the same time, interest rates are low or negative, forcing savers towards speculation. Now, in the modern era, when the deflation is not so serious as it was in the Great Depression, when the deflation is only 0.5% or 1/4%, banks aren't threatened by that. We were talking about deflation rates of in excess of 10% in the late 1920s and early 30s, in, say, 30, 31, and 32 or so, right? But banks, therefore, aren't threatened by a deflation of 0.5%. But interest rates are so low, and that's even the case right now, that investors tend to have to speculate to get reasonable returns on their investments. Now, that's even true probably for your parents right now. It's certainly true for me. I have enough money tied up in various financial assets to not have to worry about my retirement, but I have to choose, or if I didn't, I would have to choose between investing in the stock market exclusively with the high risk associated with that market, because it's been going up for more than a decade now, or investing it in yield-bearing or interest-bearing financial assets, which is normally the vehicle that is used for retirement accounts as people approach retirement. But in the latter, I would only get 0.5%, or 1%, or maybe at the most 1.5%. As opposed to traditionally a number higher than that, like 4.5% or 5%. So it may even be the case that your parents, because they're trying to grow their retirement account, have all of their investment or nearly all of their investment in the stock market and very little of it in much less risky investment components of the market. That would be characteristic of the modern investor. And a bad day can turn those markets down and eradicate 30%, 25% or more of your retirement savings when that's true. So periods of low interest rates and low prices, or even deflation like now, tend to push people into riskier investments, and then the reason for the risk is realized, and then there's some kind of minor or major catastrophe as a result of the impact of high-risk investments gone bad. It also has the effect of causing buyers to postpone purchases because prices are dropping, so why rush to buy anything, right? Let's wait a little bit. It'll be cheaper next week. That would certainly be true if deflation hit the housing market. The housing market would die. It would just stop immediately if there was some expectation that deflation would be prominent in housing, because why buy a house for, say, $320,000 if you think a year from now it's going to be selling for $290,000? The sort of rush to buy houses today, because they're doing the opposite, rising in value. Well, in Los Angeles County last year, 7%. If they were falling 7%, then nobody would be rushing to buy a house. So that entire industry suffers during periods of deflation. And this also injects tremendous uncertainty into the economy, contributing to a mood where investment levels for large businesses especially tend to be relatively low. Because you say, I don't know we can't really expand our production if we don't know what kind of prices we can expect for this. Suppose, for example, you were running a business competing with Starbucks, or you were in fact an executive on Starbucks board, and it became apparent to you that coffee prices were rising. And so you'd be a little bit concerned about that because that may cut into your sales. Well, what if you were the coffee producer instead of Starbucks, the one who sold coffee to Starbucks? Their concern, of course, is that coffee prices would be falling because they're the ones who are going to have to suffer in revenue loss if that happens. And so that type of investor is not going to be investing in expanding coffee production. And this is generally true in any category of agriculture or even manufacturing. You know, looking at the electric car industry is kind of interesting because it really hasn't taken off yet. And one of the reasons it hasn't is because of pricing issues. You know, they're kind of expensive given what, if you ignore the sort of desire to be in a car because of its green effect and some of the reasons, or tax break, some of the reasons why cars are popular now, they just strike people as too expensive, really. There's just too expensive to buy an electric car. I thought about buying an e-tron over the break to try to get the tax break, which would have been $7,500. And I went and drove one around. That's the Audi SUV size electric car. That's actually pretty well engineered, but it has one significant problem. It has the sort of range anxiety issue, right? Because its range is only 204 miles. And I use the rule of thumb, if it can't get to Vegas without stopping, there's no way I'll ever buy that car. And you can't get to Vegas without stopping if it only goes 204 miles, so I didn't even think about buying it. But on top of that, the effective price for the car was just a little under $80,000. And it's no more than a Q5 with an electric engine in it. I own a Q5, and the Q5 only costs $55,000, right? So it's not worth that additional $25,000. So these prices will be adjusting to this lack of the development of the market in electricity. And it may actually kind of show up as a form of micro-deflation in automobiles. And of course, it's going to substantially impact who the winners and losers are in that big game, right? I think the bet these days is on Tesla, who I think also today had the earnings report. If it's not today, it's tomorrow. I don't think it's a correct bet. I don't think Tesla's large enough to take over the industry. But the bet is that Ford, for example, won't come out on top on this, even though they plan to introduce their electric Mustang later this year. We'll see. But the price issue will be the issue, I think, that determines how this works out. Now, to have a sense of what we're talking about, which is the relationship between inflation and deflation and the business cycle, this graph clearly shows that relationship. And so what we're looking at here is the annualized consumer price index inflation rate. When you talk about an inflation rate, you have to use some index that's understood to be representative of the inflation rate. And for the United States, that's often the consumer price index, which is kind of the measure of the inflation rate of a generic market basket of goods that the typical consumer might buy. And so if it's going up 12%, in a given year, then one says more or less that means the cost of living for the American worker has gone up by 12%, or the American family has gone up by 12%, and that's not really an inaccurate representation. And so even though during your lifetime this has never been a threatening issue, at least on the inflationary front, assuming you were born around 2000 or so, or just a little before or a little after, as you can see, the inflation rate has never once been above 4%. And currently is actually below 2%, and this is annualized average data that we're looking at here. In the next slide, we have the monthly, and that's more volatile than the smooth average annual data. And we're looking at 2% as kind of an acceptable upper threshold in the eyes of the nation's central bank. Inflation of 1.5% is not seen as undesirable, but if it starts to move, say, to 2.5%, 3%, that's seen as undesirable, and so they may take some measures to kind of try to roll that back a little bit. And as you can see, sometimes we're a little above that, and sometimes, typically, we're below that, but not remarkably so. But if you go back to the 70s and 80s, you can see that the picture back then was entirely different. There were two very substantial inflationary episodes in that period of time that did great damage to the American economy. The first one, we can see that the CPI, and this again is the annual average, so we're talking about prices being up in double-digit ranges for more than 12 months. The CPI in 1974 was at about 11% for the year, and then it came down, and then it respiked to an even higher spike in around 1980 or so, and 1979 and 80. It was rising during 78, 79, and spiked in 1980, and that was closer to 13%. It was above 13%. And we refer to that as double-digit hyperinflation because anything above 10% is hyperinflation. It's very dangerous inflation because inflations tend to automatically get worse when they get that high. There's a certain dynamic to it that we'll explain later. If it goes to 10%, it's going to want to try to go to 20. If it goes to 20, it's going to really want to try to go to 50. If it goes to 50, then it wants to go all the way, you know. And so inflation's above 6 or 7% can become very dangerous. And so, as we can see there, we had those two spikes. Now, the peaks of business cycles are shown with them in the green lines. And by no coincidence, we see that, as we said earlier when we talked about the pathology of the business cycle, remember one of the things we said was that as the economy becomes superheated, then prices start to rise in more and more industries and can rise for inputs such as labor, material costs, and the like. And so this tends to validate that, as you can see in the small inflation in 1970, where we rose above 4%, that there was a peak of a business cycle. The business cycles were kind of compressed back in that era. And then prices came down as the economy went to the trough. And the trough, by the way, is probably somewhere near the bottom there in 1972 or so, where that bottoms out. And then all of a sudden we have the return to inflation. And at the peak of the cycle, inflation also peaks. If we were looking at monthly data, it wouldn't line up perfectly, but you know, when you're looking at smooth average data, it lines up well enough to see that there's an association. And then once again, prices came down after 1974 and then really took off the third and final time, fortunately for us, in the late 1970s and peaked right around the time of the 1980 election, which was partly responsible for the election of Ronald Reagan to the presidency of the United States and the defeat of Jimmy Carter after only one term as a Democrat. Then finally, we'll talk about how this happened. The Federal Reserve System invoked a severe policy to curb this inflation under the stewardship, as we'll see, of Paul Volcker, and it was successful, and the inflation rates did indeed drop rather quickly back down to more acceptable levels. And aside from kind of a spike again in 1990 because of housing speculation for the largest part, it has remained tepid and actually even declining since that period of time. Now, even though on the graph it looks like it declined sharply, it did in relative terms. That's still a 3-year span where inflation rates were well above 6% or so. And there's actually about a 2.5-year period there where inflation rates are above, or almost a 3-year period there where inflation rates are above 10%. And that's a long time for inflation rates to be above 10%. As I said, if you're living in a house that you paid, let us say back then, $45,000 for, and it rises in value by 10% in 1 year, about $4,500, then it rises by about $5,500 in the second year, then it rises by about $6,000 in the third year. All of a sudden your house is worth a lot more than it was when you first bought it, and yet the monthly payment on that house is the same as it was when you paid $46,000 for the house in the first place. So these two inflationary episodes were a substantial windfall gain for any of your parents or grandparents, I guess, in your case, who would have owned houses during this period of time. And it's especially true if they own more than one property, such as a vacation property or a rental property or two. This was perhaps a significant source of their wealth during that period. if they manage to hold on to it after the inflation abated. And of course, when the inflation abates, the house doesn't go down in value, it just returns to its normal appreciation of 3 or 4% instead of 10% per year. But you can clearly see that there's a strong correlation here between the business cycle and inflation rates, as the discussion of the pathology earlier suggests there would be, because when things get really heated, then of course the price inflation goes up, but then when the economy collapses back down again and we begin to experience rising unemployment and some degree of business failure, those very same pressures abate and prices resume or return to a more normal level. So there's obviously going to be a very clear correlation between inflation rates and business cycles.
If modern economies, for the most part, are always like have some level of inflation, like they're always above 0%, wouldn't that there always just be an incentive to like own houses then? Like, shouldn't you all like so that you can make money off of it if like prices are just gonna rise like regardless?
Wouldn't there always be a what?
Like incentive to just like own like have as many houses as you can afford, I guess.
Yeah, sure.
Okay.
Now, if that's the sort of investment advice you're looking for, should I go down after this inflation abates and buy 25 houses? The answer is yes. That's what BlackRock did in the mortgage meltdown, except they didn't buy 25. They bought 25,000 houses. And they've sold them all since then, and they made staggering amounts of money on that. So yeah, if you're looking for a way to explain the topic we'll discuss later, how the 1% get the 90% of the wealth, it's through means like this. And I'm not kidding or exaggerating. It's exactly through means like this. That's right. So yeah, I'll tell you the real estate stories in more detail later on, because the leverage effect you get from having a fixed rate loan on something that rises in value despite the fact you only put 10% down on it, all of that is the key to why all of a sudden you have so much value creation of wealth for whoever happens to own that property. Okay, so now in looking, by the way, for 2019, this is monthly data that is annualized, and what we're doing here is taking the natural log of the price minus its value 12 months before. And that's how it's being annualized. And you can see there, of course, you get a lot more volatility because you're compounding up the monthly rate into an annual rate by doing that. And you can see we get quite a bit more volatility in this, but it's still, averaging just a little above 0. But you can see evidence right there of a time when there was a substantial decline in prices as measured by this. And that was largely due to the decline at the time in energy prices, and specifically oil and natural gas prices, right? They were so substantial and are such a significant part of the economy that there were general commodity prices were actually coming down at the time also. Agricultural products, cotton, metals, copper, and the like, but also oil and natural gas were coming down. And so that actually resulted in spikes on the downside. I guess it's not called a spike when it's going down. I don't know what a downward spike, an inverted spike. Inverted spikes of minus 25% when looking at the annualized rate of the monthly rate of change, right? So, of course, there you're only looking at maybe for that month a 2% change for the month, but annualized that comes out to 25%. So you do get a lot more volatility when you're taking a look at monthly data, looking at it in this way. And you can see sometimes that there are episodes of deflation that are very short-lived because of these big swings in commodity prices, and they matter at some point. Less than they used to, but they still do matter. Oil doesn't matter nearly as much as it used to in this economy, but it still matters some. Now, remember, one of the connections that we talked about, or the correlations, was the correlation between inflation rates and interest rates. That's one of the identities we defined as potentially harmful to the economy. Inflation harms the economy because it drags interest rates up with it. So here, over that same period of time that we were looking at, roughly, the earlier graph went back further, starting in 1972, but coming up to the modern era, we're looking at, again, the Consumer Price Index, annualized inflation rate, but we're also looking at 10-year Treasury bond rates and mortgage rates for 30-year fixed-rate mortgages during the same period of time. And the CPI is the black line, and the 10-year bond is the middle line typically in this, and then the mortgage rate is the red line that's so much higher. And you can see that there is at least a crude correlation between the rise in interest rates and the behavior of bond rates as well, although it's not a perfect correlation, we'll note. Now, one thing that's remarkable about this is as the inflation began to be experienced in the 1970s and 80s, by the two peaks that we saw there, right, you can see that interest rates followed up quickly, but for some period of time were actually negative in real terms, which is to say, when at least using annualized data, the nominal market interest rate was below the inflation rate. And that means that the real rate temporarily was a negative rate. That will not happen in the modern era. That won't happen again. The markets are now far, far more responsive to inflation rates than they were 40 years ago. So at the present time, if inflation rates were to rise or fall, the bond rates for intermediate to long-term bonds and mortgages will respond more quickly to that than it did back then. But nonetheless, they rose. But you may remember that I commented that the CPI inflation rate actually came down rather sharply after 1981, right? And that's reflected here again. Boom, it comes straight down. But you can see plainly that although that happened, the rates on mortgages especially, but also 10-year bonds, and in general, I might say, did not come down nearly so fast, right? They came down, but with a long lag. And that indicates one of the problems of having to fight an inflation. To fight an inflation, you often have to intentionally raise interest rates as a counter-inflation measure. But then expectations are then baked into that market to where even when you defeat the inflation and it quickly comes down, the interest rates in the economy don't come down quite so quickly. They stay up much, much longer because there's always this fear that at any moment inflation can return. So, for example, if we look at the CPI, we see we have it back down below 10% in 1981 or so. So you ask, well, when does the mortgage rate come down to 10% or below? 1990, the mortgage rate comes down finally below 10%. So basically 10 years later, mortgage rates are still in double-digit ranges. Now, if you think about these mortgage rates, the red line again, what that would imply for the modern economy. When we take a look at the inflation of the 1981, we're saying that the 30-year fixed-rate mortgage available on average for the entire year was 17%. Now, the cost of a monthly payment on a house is almost proportionate to the size of the interest rate you pay on that house. In other words, if you have a 30-year fixed-rate mortgage at 4%, if it rises to 8%, then the monthly payment will more or less double. And that's because it's amortized over 360 payments, and so it's almost proportionate. So if the interest rate increases fourfold over what it would have been by its historically low level, that means that the typical monthly payment on that house is 4 times higher than it otherwise would have been. So there's not much that really encourages anyone to buy a house when interest rates are in double-digit ranges. When I first started work here, couldn't even think about buying a house because the interest rate locally on a fixed-rate mortgage was 17%, as opposed to what I presently pay, which is 3.5%. Well, there is no house affordable at any price with a 17% mortgage. Besides, who in their right mind would want to lock that in for a long period of time? You, of course, could refinance out of the house at a lower rate before your 30 years is up, but nonetheless, you're going to be paying that really, really high monthly payment for a long time before you're able to do that. But as we can see, 10% is unacceptably high now, of course. What do you think would happen to the housing market if interest rates for mortgages were 10% right now, as opposed to under 4%? It would come to a complete screeching halt, and the already critical housing shortage we have in subcities would get considerably worse than it is presently. And yet we can see that the rate on 30-year fixed-rate mortgages stayed above 10%, as I say, for more than, well, actually, all told, about 1977 to 1990. So 22 or 23 years. So this is why you never want to see an inflation. This is why inflation is regarded as one of the worst things that can happen to an economy. And these are moderate levels of inflation compared to other historical examples and compared to the kind of inflation, for example, that you see today in Venezuela. Although the Venezuelan economy is literally a smoking black hole. There's nothing left of the economy. People are starving to death there, causing a mass migration out of the country simply for the purpose of survival. And so that's an example of how bad things can get if inflation rates are very high. So when you look at the financial side of the business cycle and the implications of letting it run too far on the expansion, for example, into inflation, you realize that the downside of that is very, very serious. And even when there's a correction, the market is not necessarily convinced of that correction immediately. It has to have validation for that correction, and that may take 5 or 6 or even 10 years for the market to be satisfied that, yep, they finally got inflation fixed. So when we take a look at the present period where we have almost deflationary rates, it's atypical. And we'll come back to that story time and time again. Okay, so what we were able to talk about there then was at least an opening introduction to the financial side of the business cycle as measured by the two strongest phenomena, the behavior of prices and the behavior of interest rates. Now, at this point, partly because of the way I changed this schedule around, I'm going to introduce a topic that I always randomly introduced as tied to this at this time. And that is the controversy that you're already aware of over the maldistribution of wealth and income in this economy and the global economy that is capturing so much attention, for example, in the national election, or is likely to capture more attention after the impeachment trial is over and the race on behalf of the Democrats to finally secure a candidate, and then finally the race itself between Trump and whoever wins the Democratic race proceeds. This issue will, of course, come up. So you've heard time and time again, I'm sure, about the 90%, the 1%, the 10%, and all of that. Well, the stories about how there has been a very serious maldistribution of income and wealth, but especially wealth, are not exaggerated. They're quite true. This is not kind of a left-wing proposition exclusively. Most of the data that I draw about evidence for this comes from conservative sources like the Wall Street Journal, the Financial Times, or in the case of what I'm providing here, the Federal Reserve Bank of St. Louis, which is not a liberal institution. The controversy, of course, is over income and wealth distribution globally, but certainly also in the United States, and the fact that it appears to many people when they look at the data, and they're correct about this, that most of the delta in wealth creation in this economy now goes to a very small group of people. And I began Econ 104 by talking about this, saying, yes, that's true. The reasons for it are not difficult to figure out and understand. And I point out to Harvey Mutters that almost all of you are destined to be in that upper 10%, and a sizable percentage of you are destined to be in that upper 1% for the very reason about why the wealth does accrue to a relatively small part of the population. And we'll get into that later. Let's look at the data to see what people are complaining about. So this was the triumph of injustice. This was exposed in the Los Angeles Times on December the 10th, 2019. And so the argument here is that when you take a look at how much, let's see, are we looking at wealth here, income? This is take-home pay, so this is income. When you take a look at the bottom 50%, in 1970, that amount adjusted for inflation was $19,000, and in 2018, that amount was $27,000, and so that's represented by the little blue line there that's at the very bottom of the graph that you can barely see. But when you take a look at the top 1%, for example, that income, this is mostly based upon tax data, I might add. The cohort earned $328,000, and now that has grown to $1,152,000. And so much of the growth, therefore, that basically at the bottom we find that incomes increased by, didn't even double, actually. But when we get to the top 1%, especially, then they increased fourfold. But when you get to the top 1/10 of 1%, they increased fivefold. And then when you get to the top 1% of 1%, they increase eightfold. And so that's the orange line. And the 50 to 90%, the sort of upper income group in the United States, is the red line. And so study after study after study, where you use tax data, you use other kinds of data, income, wealth, and so forth, are tending to demonstrate that in the modern economy, and especially the U.S. economy, but also the global economy, that we're beginning to see that almost all of the gains in wealth especially, not so much income, but wealth especially, accrue to about the top 10% of the population. About 90% of the gains go to 10% of the population. Now again, as I point out in Econ 104, you're in the 10%, or you're destined to be in the 10%. You say, well, is my income right now at the median for the 10%? It's not that far away, but for your age cohort, it's way above the 10% cutoff line for the age cohort. And so I guess if you're looking at this individually, this should not be seen as bad news. But if you look at it from a more sort of social perspective, perhaps you would regard it as bad news. Now, it's because of that that I've asked you to read this book, which is kind of about you, your age generation. It's not a book. It's the assignment you'll see there on the course calendar is for about 20 pages or so out of this document, this PDF document that's online. And so it's mostly comparing your age group to my age group at your age, for example. So how did I look when I was 19 years old and 25 years old and 30 years old compared to how you look at 19, 25, and 30, right? And so that's most of the comparison we're trying to get. So I'm asking you to read that. And after you've read that, we'll talk about it a little bit more. But it makes it obvious that if you think of your age cohort, especially if you include everybody in that cohort, which is everyone your age, not just those of you who went to the most expensive school in the world, that you're not doing very well compared to how I was doing when I was your age. I have twice as much wealth as you had. Again, speaking when I say you as an average across your age, not you students at Harvey Mudd, twice as much wealth as you had. By the time we get to 25 years of age, 5 times as much wealth as you had. And so, in other words, it was fairly easy for someone in the middle class going through my age group, when being your age, going through college age and just beyond that, to accumulate wealth compared to how possible that is for your age group now. And so they break this down in this study by education, by race, by gender, by age, and you name it, and you can sort of all the stereotypes you would expect to emerge from this will emerge from it, right? So, so I'm having you read that. Now let's see, the example I have down there is on median income, and so the early group degree without debt, 75,000 compared to 61,000. So there's no degree, 49,000 compared to 36. So that's an example. It's comparing people who are 25 to 34 years old in those 2 years, and it's adjusted for inflation. Now, the rest of the research I'm going to refer to is from the Federal Reserve Bank of St. Louis, and this was just published. This was just published in August. And it was pretty shocking even when I saw it. I'm kind of aware of this. I'm thinking, wow, these are pretty distorted numbers. So let's take a look. I'm not asking you to read this. I'm actually just showing you the summary of it right now. Let's take a look at income distribution, 1989, pre-tax, 2016. And so, again, the top 10% of income earners in 1989 withdrew 42% of the total income, whereas in 2016, 50% of the income. So there's been a big increase in their slice of the pie. But the bottom 5% has shrunk from 15 to 13, and the middle has shrunk from 42 to 37. So this confirms a little bit again that income distribution in general, and this is not wealth, because the really remarkable differences in wealth rather than income, just very gradually more and more of any slice of income is going to the upper group. Now when you take a look at wealth in 1989 compared to 2016, then and it's always been high for the top 10%, but the top 10% claimed 67% of the wealth in 1989, and now they claim 77% of the wealth in 2016, and the bottom 50% basically had nothing then, they have nothing now. And we're seeing the bottom 10%, no, the bottom 50% of the economy in the United States, or the households, I should say, in the economy, have no wealth effectively socked away. And by that I mean net worth in house, savings of any kind, and investments of any kind. Basically, they don't have any. And this is one of the reasons, by the way, why the wealth figures are skewed. And I explain this, it's just very elementary in Econ 104. If you go to work for Google, or Intel, or Apple, or a high-paying tech company, the day you start work there, they'll enroll you in a generous 401k plan where they're likely to match your contribution to your own retirement account, or even in some cases pay twice as much as you contribute. So from the moment you start work at age 21 or 22, you're already starting to save, say, $10,000 or $12,000 or $15,000 per year, most of it in a market that has been consistently rising in value at 10 or 15 or 20% per year. So no big surprise that at age 35, you have $450,000 socked away, and someone that you went to high school with, who's just sort of a member of the middle class, but does not have that kind of pension contribution, has nothing socked away. And that's where these numbers come from. Like I said, when you think of the upper 10% or the upper 1%, you're thinking, well, they must be talking about Bill Gates, or they're talking about you. Or they're talking about your parents. Most of your parents are in the upper 10% of income. In the United States, I think the income value for the upper 10% is, I think, $178,000 a month, a year, or more. Right? That's not very much money, actually. So if you think about it, so you say, "Wow, you mean people actually make under $178,000 a year or more just because you got an offer from Apple for $900 an hour or whatever they're going to pay you?" Yeah, most people don't make that much money. I don't know if you've talked to your high school friends since you left high school or not, but they're not making that kind of money. They're working in a coffee shop as a barista, making $12.50 an hour, and that doesn't add up to $178,000, even if you work Saturdays. So the wealth distribution, of course, is skewed, and it continues to get more skewed for the reason I just pointed out. A lot of it, you say, well, they did IPOs and they had unicorns and stuff like that. You read about, well, there is some of that. I have lunch all the time with Harvey Mudders that have a net worth of more than $250 million. And then Friday in my office, I had 3 of them sitting in there talking to me, right? That's a common story here anymore. But we're not talking about them. They're the 1% of the 1% of the 1% of the 1%, right? We're talking about 10% is, as I say, incomes of $180,000 or so and above. So this is turning out to be a big political issue, as you might guess, with Elizabeth Warren, especially, and Bernie Sanders, putting it almost in the center of their campaign. What concerns me a little bit is, I recognize it actually is a problem, and it's a problem that I think that socially we should try to resolve to kind of keep the income distribution a little more fair, or at least a little more even, so that we don't have social upheaval, because the result ultimately is social upheaval. But of course, the solution is often taxation. And rather than trying to kind of get to the root cause of it and say, let's try to redistribute this income a little bit so that young people can save money and invest it, and like that, so they can be like the people who are wealthier. Instead, we'll just get hit with a tax hammer, I think, is going to be the solution if there is a solution. I noticed that today that Bernie Sanders is actually leading in the California polls, which surprises me. Nobody has a majority, of course, but it's a plurality lead, but it's more than Biden and it's more than, quite a bit more than Elizabeth Warren. She seems to be kind of slipping back. So the sort of let's tax them progressive voice is being led increasingly by Sanders and not Warren. And the old white man who's on the brink of death voice is still Biden. And the young white man who's in better shape is Buttigieg, but nobody seems to like him very much. So it looks like it's down to those three, maybe, huh? Biden, the old, bumbling, senile guy who can beat Trump, against the two progressive warriors that's going to straighten this mess out. We'll see how that all turns out. Against, of course, a pathological lunatic who's presently president of the United States. Now, the white Hispanic wealth gap, of course, is remarkable. And the white and black wealth gap is also remarkable. And so it's kind of hard for you to see this maybe up there. You can see it a little more clearly. In fact, it's hard for me to look at it and see what it's actually saying unless I look at this bigger monitor over here. I can't even read it down here. So let's see so the white families on the graph that's on the lower left. So that's the median wealth for white families. Okay, that's the blue line. So median wealth, right? Not mean, because you don't use mean because it's so skewed because of the rich, right? So then you see that the median wealth for Hispanic families is actually down quite low, but the 74th, so why 74th? Oh, 75th percentile for, that's Hispanic, sorry. So the 75th percentile for Hispanic families is the red. So that's the median's the 50th percentile, right? So even the 75th percentile for Hispanic is not as high as the white, but it approached it, as you can plainly see, in 2007. And then the impact of the mortgage meltdown pulled it back down again, right? So Hispanic family 75th is well below the white median, and of course the bottom line there is the median for the Hispanic family. So that's way down below. And you say, really? Are you kidding me? The wealth represented by the median white family is 163, and the median Latin family, let's see, is 22. That's right, those are real numbers, and that's why there's a lot of concern about this, right? Then when you take a look at the black-white wealth gap, at the very top you see that once again the white is before at 163, and the median for black is 16. It's even worse than Hispanic. And again, the 75th again was approaching at least the median for the in 2007, as the economy went through the big buildup that was real estate finance, and then it just completely collapsed, and once again, wiped out that spread. And so, of course, if in an election campaign you rely upon or want to count on Hispanic voters or black voters, this is going to be a big deal, right, on potentially how they vote. So, looking at it from the standpoint of race, it's a more serious problem even from just the standpoint of income distribution, and has a potential to play substantially into politics. And it's similar elsewhere, of course. It's not just a U.S. phenomenon. When we get to educational attainment, let's see again, I have to see the big screen here. Then the postgraduate, that's us. Oh man, do we make a lot of money. And then we got the bachelor's degree, which is still doing pretty well. Well, you can see that education pays off. And again, where it really pays off is in wealth, for the reason I just pointed out to you, right? If you graduate from school with that degree, you start into a savings program typically that is 401k based, if nothing else. Then you buy a house at an early age because you had a finance professor who told you to do that. And then that house rises in value, and the stocks rise in value, and the bonds rise in value, and the ETFs rise in value. Big surprise that your wealth after in 2016 is double someone who has a Bachelor of Science or a Bachelor of Arts, and it's considerably higher than a high school graduate or somebody down there who's a high school dropout. Big surprise. But again, those numbers are more skewed than most people realize when you look at them, right? It's not a small spread that we're talking about here. It's an absolutely enormous spread. And then college grad versus non-college grad on comparative wealth. Don't need to say much about what that graph is telling you. 1989 and 1998. The point is that it's not really getting better. If we go over almost 2 generations, it's still really skewed. For every $1 in wealth the median white family had, the median black family had 11 cents, and the median Hispanic family had 12. And that was back in the old days, 1989, 1998 or so. Then now in the modern era, it hasn't changed all that much. For every $1 that the white family has, and the black and the Hispanic family have pennies on the dollar compared to that. And then for college grads, it's fortunately a little closer, but it's surprisingly still skewed, isn't it? Right? Because we're talking about, well, they're college graduates, so it's not as though they're unemployed or anything like that. And yet still, looking at that, there is a massive pay discrepancy. And unfortunately, this study didn't have gender comparisons, but when you take a look at gender comparisons, they're obviously not as spread, but they are, we'll look at those later, they are different. Males have higher wealth. The problem, by the way, with the gender comparison is that the most common unit from which they draw data is the family unit, and so in that unit they count it as family income. So you have to qualify gender comparisons for wealth. You don't quite have to qualify it so much as for income, because the individual family members have separate incomes, but basically they share the same wealth. Okay, so we're going to be aware of this issue, at least statistically, as the election year proceeds, because it'll surface and is at the core of macroeconomics. And you'll hear proposals right and left about how to bring this back into balance. I listened to the Tom Steyer on television. He's trying to buy the election by simply advertising, not realizing that the technology that he's using is obsolete. Nobody participates in it anymore except old people. And so it's a stupid policy if there ever was one. And Bloomberg's doing the same thing, advertising on the NBC Nightly News. And nobody under age 70 watches the NBC Nightly News. None of you watch the news, right? You probably know what a news program is. Are you aware that these antiquated structures called television networks actually dedicate half an hour a day to what they call the news, where they get up and start talking about Kobe Bryant for the next 3 months? And so that's the news. And so they're advertising on those channels hoping to sway your vote, and you don't even know they exist. So, okay, when we get the data, and I'm going to conclude with this, when we get the data Thursday, then we're going to undertake a complex study with the data. I won't have the results of that by class time on Thursday, but I'll have it by the following Tuesday. And all I'm hoping that you understand out of this is the conclusion that we draw. I'm not asking you to understand the methods that we use, but the conclusion that we draw. But I am going to discuss the method because I think it'll help you understand the conclusion. Now, you'll see on these slides that it says DWBH. That means don't worry, be happy. I'm not going to ask you anything specific about that slide, but I do want to show you an important study, and you need to kind of understand the method that I use to get the results of the study. So here's what we're going to do after we have looked at the raw data. So this is about a week from now we'll do this. We want to compare the average growth rates and standard deviations of the growth rates for the components of GDP to GDP itself. Now, you're saying, what does that mean? When we break gross domestic product down into its components, as we're going to do on Thursday, we'll have consumption, investment, categories of consumption, service spending, and stuff like that. We're going to take those disaggregated components of GDP and we're going to calculate their log growth rates over a long period of time, and we're going to calculate the standard deviation of each of them to see which of them is the most volatile. And that'll be a more modern and a sophisticated way of looking at the causes of business cycles, okay? And so you say, well, what's a standard deviation? Well, this is why I can't hold you accountable. Some of you know what a standard deviation is, some of you don't. Some of you have used it, and some of you have not. And I'm going to show you the formula. And if you have a bit of a math background, even if you don't know what it is, you can tell from the formula what it is. But it's going to be a measure of dispersion that I think is fairly easy to explain. And so what we're going to do is we're going to calculate the natural log growth rates of all of these components. And then we're going to take the standard deviations of those growth rates. And you may or may not understand exactly what I'm saying now, but after you see the data, it'll probably be a little easier to understand. Okay, so a proxy for a cycle candidate for that thing that causes the business cycle will be the standard deviation of the log growth rate of that component over, say, the last 20 years or the last 10 years. And we say, well, if residential construction investment has a really high standard deviation and medical services has a really low standard deviation, then it's retail construction that is contributing more to the business cycle than medical services. That's the kind of conclusion we're going to draw. We're saying if something, the growth rate is across a wide measure of dispersion, let's say it has an average each year of 5.246%, but it has a wide measure of dispersion with that average, that's going to be a candidate for the cause of the business cycle, all right? And we're going to normalize it by comparing it to the growth rate and standard deviation of GDP itself. This is a common type of analysis. So we might be able to say, well, the variance of that component is twice the variance of GDP, so it's obviously contributing to the business cycle. That might be residential construction. It turns out the standard deviation of residential construction is 5 times the standard deviation of GDP, and it's the most active element in the cause of the business cycle. But we'll look at other categories that are less than 1, meaning they're very stable and are therefore not contributing to the business cycle. Now, when I talk about the log growth rate, it's the item on the bottom. And there at the top of the slide, it says DWBH. Don't worry, be happy. I'm not going to ask you this. You either know what a log growth rate is or you don't. If you're a mutter, you probably do. If you're not, you probably don't. And I'm not, it's just, you take the ratio on a time series data, you take the ratio of the natural logs. If you're curious about the application of this, which is common in finance, this is definitely not required for this course, but if you're curious about its application, that YouTube video at the top explains it. And so it's pretty commonly hit by people that want to know how that works. And so we're using the log growth rate, which is always going to be just a little bit below the discrete growth rate when you calculate it. Discrete growth rate's about 115%. If we're looking at one observation of 100, the next observation of 15. The log growth rate for the same is a little under 14% because it's effectively a continuously compounding growth rate. All right, and so that's the growth rate we use in the science. And then we calculate the mean and the standard deviation of that using the standard formulas for mean and standard deviation. And we end up with this graph. Now, this won't be ours. This is an older one. So we can say, well, GDP normalized is 1. So durable goods is 3. That's very volatile. 3 times the standard deviation of GDP, and residential construction is 5 times the standard deviation of GDP. And then we see things like consumer services is 0.78, so not even as volatile as GDP. And this will allow us to conclude, after we do it for the 2019 data, that these categories like consumer durable goods, residential and non-residential construction, and equipment and software purchases are the biggest contributors to economic cycles in the United States, and our expenditures for services like medical services are the most dampening parts of the business cycle and tend to mute or mitigate the effect of the business cycle in the United States. So after we have the new data, I'll more slowly again go through this, and so we will have moved a little bit from the sort of anecdotal treatment of the discussion of the pathology of the business cycle to something that is more strongly supported by analysis of numbers, right? So we can say, okay, when we talk about automobile sales as a part, for example, of durable goods, wildly cyclical, real estate sales wildly cyclical, and we can show it in data, and we can show it by using the visualization of those components in graphs, and we'll do both. And we'll understand a little bit more about why there's a business cycle in the United States and what is the biggest contributor to it, and what, in contrast to that, has a dampening effect, okay? So again, you may not have understood this. I don't think you really need to understand it to understand what we're saying in the final graph, but go back and take a look at it to see if you care to try to understand it. It makes it a little easier to remember, I think, when you take a look at it. And again, if you have a math background from then this is pretty easy to figure out. And the next time I see you, I will be telling you how the GDP numbers came out this morning, and this is what they said, and this will be the possible effect upon the next presidential election. I'll say Trump is going nuts on Twitter. And which way is he going nuts? So is he like really upset, or is he celebrating his great victory over GDP? So it's never a question about whether he's going nuts on Twitter. It's what he's saying while he's going nuts on Twitter. So we'll be interpreting his Twitter messages the next time I see you. Signing off. Yes.